Hello, good afternoon, and welcome to HYCM's webinar, the FX Week Ahead. It's live market analysis with myself, Giles Coughlin, a currency analyst with ForexLive.com. Hello, welcome, and looking forward to this next week that's ahead of us. It's a very interesting week, and we're going to be going through a lot of details in this webinar. Just want to see everyone. Just give me a little a message to check that you can hear me okay, please. Make sure my audio is coming through. It's great. Hello Efrenio, hello Ahmad, hello Catherine, Daniel, Emily, welcome back, Hanan, Jesse, La, Olga, Sanya. Well, yeah, that's great. Thank you for the message, Hanan. That's super. I'm glad you can hear me coming through good. Yeah, good afternoon to you, Jesse, and hi, Efrenio. That's great. Just give folks a chance to read the disclaimer that we have there. We've got a lot ahead of us this week, and we're going to be looking straight ahead with the Brexit negotiations that are going on. Once again, we want to look at the geopolitical concerns that are affecting the markets at the moment, because some of these concerns are more important than individual calendar events. So in order to understand the context for the British pound, it's Brexit news, which is the single biggest factor that is affecting the pound at the moment. And of course, it's to do with Britain's relationship with the European Union after the British people voted to leave the Eurozone. Theresa May, Britain's Prime Minister, is now in intense negotiations with the European Union, trying to work out exactly what a relationship with the EU will look like post Britain leaving the EU. And this has been a constant concern for the markets recently. And we're not going to go into the background of the whole saga because it would take more than half an hour itself. We're just going to jump straight into where we are today. And where we are today is we have Theresa May is about to head into the EU summit on the 17th and 18th of October and this week, and is trying to secure a deal for Britain that means Britain kind of keeps some benefits of being in the European Union, but doesn't have the free movement of people. That's what Theresa May wants. She wants the free movement of goods, but not the free movement of people. And the European Union are finding it very difficult to reach a compromise agreement with Theresa May. She has a plan called the Chequers Plan. And as we're speaking now, there is a quiet sort of, well, a growing rebellion going on for Theresa May within her own cabinet. And what Theresa May's, the problem for Theresa May is that the cabinet, and David Davis used to be the minister for Brexit and resigned over Theresa May's Chequers policy. And what David Davis is saying is that we might rebel over Theresa May's Chequers plan. And there's a growing sense within the Conservative Party that Theresa May's Chequers plan is unworkable. Now, over the weekend, there were intense negotiations that took place between Britain and the EU. And we have a new Brexit minister, Mr. Raab, who has been negotiating. And the indications over the weekend is that they weren't accepted by the EU. So now Theresa May has a problem. And the problem she has is that the EU don't like her Chequers plan, and her own Conservative Party don't like her Chequers plan. Then the alternative parties in the UK, so the Labour government, has recently put forward the suggestion that they would consider putting through a new referendum on whether Britain really should leave the EU. So the support for Theresa May is waning, and she has a tremendous difficulty trying to get through her plan. And all of this means that what's called a hard Brexit outcome is seeming more and more likely. Now, the market considers a hard Brexit outcome, which is basically a severance of the relationship between Britain and the EU, as the worst case scenario for the pound. So what you need to be aware of is that hard Brexit scenario is kind of rearing its head. Now, recently, the pound had been appreciating over the last sort of few days at the end of last week as the kind of optimism grew about a good relationship being secured by Britain and the EU. And most people think that Britain and the EU will work out a deal. But you've constantly got this sense of uncertainty. So the way the market has sort of acknowledged that uncertainty is you see these technical places, the 200 moving average. Each time prices touch the 200 moving average, it's sold off. Again, prices touch the moving average, it's sold off. Now, what's happening now as we're on this webinar, and there's been a few situations when I've been on the webinar and you get some sort of significant breaking news, and I was wondering as I was preparing this webinar whether we're going to get exactly the same again, because Theresa May is due to be speaking now, and she's going to be addressing Parliament on the latest Brexit outcomes. And what I suspect that she's going to be saying is that, you know, there's been more difficulties ahead, and the more difficulties that she's experiencing, the harder it's going to be for her to persuade her own party to keep holding on to that Chequers plan. So it's looking like there's going to be more bearish sentiment coming into the pound ahead of the EU summit. Now, it was hoped that the EU summit, there could be a good relationship secured by the end of the summit, but it was always made clear that if the deal wasn't done in October, then maybe it could be done in November. So that's the kind of scenario we're in. The big picture is people think a deal will get done, but there's always the risk and there's always the uncertainty that it won't get done. So again, how to trade this? Well, if you're wanting to trade this, the obvious place to short the pound would be to put your stop above the 200 moving average, because that's kind of the place where the market has said, you know, we don't think the pound has enough value to move above the 200 moving average. The market isn't confident. You can see it sold off quite heavily on that test there. Again, a heavy sell-off, and you see that price gap down over the weekend on the bearish news that we've been talking about, with the EU not liking the proposal by Theresa May, and you know, that negative sentiment. So that's the scenario we have for the pound, and I think there's more negative sentiment ahead. That before the deal does get done, there's going to be more negative news coming out. So typically in these kind of negotiations, it gets tense, and people talk about, well, you know, Britain could say, well, we don't mind a hard, you know, no deal is better than a bad deal. You get that kind of rhetoric coming out, which of course would weigh heavily on the pound. So we will be looking at the sort of coming up in the next few weeks. We will be looking at some workshops that are run free by HYCM, and I will be taking you through an hour's worth of trading roughly to show you how to define, limit your risk, where you can look at entering trades, where you should be placing your stops, and actually really going through the nitty-gritty of trading, what it actually looks like. So that is something that will be coming up ahead. You will find details sent to you via the email, so look out for details of that coming up on your email, and that will be run by myself. So there's some workshops coming up, so we won't go into a lot of the trading information now, but coming up ahead it will be. And again, it will be free once you've registered with HYCM. If you've registered an account with them, you will get that workshop training for free. So that's good news, and that's heading up, and I'm really looking forward to really zoning in and trying to show you how to, you know, trade these kind of these sentiments scenarios. But for now, you could see, you know, you might take a view of, I think there's going to be more negative sentiment for the pound. So, you know, the low risk, high reward place to enter would be to enter again on a retest of that 200 moving average. That would be the obvious place. Now, this isn't trading advice. I'm not telling you you should do it, but what I'm trying to do is educate you to show you how you make trades, the sort of places you want to be entering, the sort of things you want to be doing. Now, that is a very good place to enter. The 200 moving average, you could have quite a tight stop just above the top, and you could make for a play down to you know, 2, 3, 4, 5 times what you've risked quite happily and quite within a good boundaries. And you know what's going to be the marker that decides whether the 200 moving average holds or doesn't hold is going to be the likelihood of the Brexit deal being sorted out in an orderly fashion. So if it's good news, if Barnier says this week, fantastic, we've managed to work out a deal with Britain, and it's going to be a really good deal. And Theresa May says, yes, we've managed to get everything we wanted. We've got free movement of services and goods, but we've limited the movement of people. That's exactly what we wanted. Then you're going to see the pound rally strongly on that kind of news. I think that's unlikely, but it's possible. And I think the most likely scenario is we're going to have more, umming and ahhing and, oh, I'm not sure about whether this deal can be done. And that's likely to weigh on the pound. And the pounds are very unlikely to move above that 200 moving average in that environment. However, as I've made clear, this is what's called headline risk. So there's risk that the latest headline will push the pound in a strong direction. So you have to be aware when you're trading the pound US dollar pair that at any time a headline can come out from either Barnier, from Dominic Raab, from Theresa May, and that can move the pound, 30, 40, 50, 60 points very easily. So that's the kind of risks that are associated with that kind of trade. But if you were thinking, oh, I'm sure the deal will get done, then some people have suggested entering long with wide stops and then making a larger play up to the top side. I don't like that. I don't like the size of that stop. I prefer to try to find really simple and logical places to enter the market where you can define and limit your risk in a better way. That's my preference anyway. Okay, that's just a quick look at the pound, quick look at Brexit. We've had a little look how to trade it now. Very interesting. This is the EU trouble with Italy's GDP deficit. Now, this is a story that keeps coming back, and it's a common problem that the Eurozone have had with countries failing to really run their budget in the way that the EU want the countries to run their budget. And what's happening with Italy's budget is basically their debt, and their debt is running at $2.3 trillion, which is the equivalent of about 130% of Italy's GDP. So their debt is, 131% of their entire gross domestic product. The Eurozone itself has got a limit of 60% maximum debt that each country is allowed to have. So each country can have a maximum debt of 60% of their GDP. So you can see straight away that Italy has broken that rule with 131% debt of its GDP. The average Eurozone country, out of interest, is about 86.5% of their GDP as debt. So the average country has, greater debt than the Eurozone like their countries to have. So you can see there's a little bit of wiggle room that the EU allow for that. But having said that, Italy's is really high, 131%, and that begins to cause concerns. Now, this year, the country's running a current account deficit of about 1.8%, okay? However, there was a newly elected Italian government that came in March. And what's happened is they've really irritated the EU because they've said, okay, our forecast now is for a deficit going forward of 2.4%. Okay, so next year we reckon we're going to run a deficit of 2.4%, and that's irritated the EU because the previous Italian government had said we're going to run a deficit of 0.8%. So in other words, they're working at trying to cut back that huge debt that the country had. But the new government is saying, no, we want to spend, we want to give more infrastructure for our country. They've made political promises that they're determined to keep, and they're going to keep it by running into more debt. So the deficit is going the wrong way, and the Italian government has taken this combative stance with the EU as well. So you look at the rhetoric from the EU. Oh yeah, sorry, Ashtos, just a question. The red line is the 200 moving average, and the blue line is the 100 moving average, and I use the exponential moving average. Okay, so just to make that clear, when you're looking at the charts, I'll just quickly flick that up, answer that question. The red line, 200 moving average. the blue line 100 moving average, and the yellow line is the 50 moving average, and I use the exponential moving averages there. Yeah, that's just to make that clear. But that's that's the trouble with Italy's GDP deficit. So what's going to happen next is today Italy was meant to submit their GDP deficit to the EU formally. Okay, so in theory, if the EU really hate it, they might ask for Italy to revise their budget. So look out for that later in the day. I did see a headline that crossed the wires this morning saying that Italy is going to defer submitting their budget till tomorrow. Okay, and Italian government is meeting this afternoon at 3 p.m. Obviously, domestically, they've got to work out, do we want to really aggravate the EU? Because that's the stance they've taken. And the question of their aggravating the EU has made some commentators think, yeah, there clearly are people within the newly elected party that want Italy to leave the European Union. So do you see all these little different factors you've got to sort of weigh in? But this is kind of negative for the Eurozone, this kind of rhetoric. So if they go ahead and submit a 2.4% deficit, it's not the end of the world, because like France had a public deficit about above 3% for over 9 years, and they kind of escaped getting into big trouble with the EU. And it's similarly like Spain and Portugal, they avoided fines when they had a public deficit that went over the limits. But the problem for Italy is if their debt looks really high, then they could get punished in a different way, because investors could start to retreat away from Italian debt. And we've already started to see that. We've already started to see that the yields for the Italian bonds have increased. And the way that bonds work is when the yield increases, the value of the bond decreases. So essentially an increase in yields is a decrease in the value of the bonds. It's a complicated relationship to get your head around at first. But the bottom line is that Italy's debt has become less attractive. And if the market looks at Italy and the stance they're taking, they could pull out more and more support for Italy's debt, which means their borrowing costs are going to rise, and then Italy's government is going to be in more trouble. So it's a difficult scenario, but there's some of the factors you need to look at to guide the European sentiment. That's what you need to look at, and that will weigh on the euro. So you've got to factor how that situation is playing out, and that will affect the euro. Okay, let's go on to the next slide. Next slide, just wanted to quickly flag this up to you. The US-China trade war, it has been bubbling away for quite a few weeks and months now, but it has started to ramp up now, and it's just starting to bite. And I think, interestingly, with the US, Donald Trump has got the midterm elections coming up. He's got the NAFTA agreement sorted between Canada and Mexico. That's all done and dusted. But that was a different kind of beast. At the end of the day, US and Canada, they're much more friendly countries. US and China are much less friendly countries. And China is a growing power, but obviously it's not comparable to the US yet, despite what some people are saying. China has a kind of unwritten rule with the world, which is that we produce it cheaply and you buy it from us. So it's an oversimplification in some ways, but there's a lot of truth to that idea. And China needs the US more than the US needs China. So in any kind of US-China trade war situation, China is going to look to kind of try to negotiate, try to make Donald Trump happy, try to stop it really flaring and aggravating. But that hasn't really been working, and Donald Trump obviously likes to tweet, and he's been tweeting his ire at China, and the US Vice President Pence was coming out and saying similar things to Donald Trump. So the stance of the US is one of antagonism towards China. Now, the IMF has recently stated that global growth looks like decreasing, and one of the key kind of drivers for that global growth decreasing is the tariffs that are being placed on Chinese exports by the US. And this kind of is going to affect US inflation. It's going to affect orders that are going into Chinese factory and production. So that's one thing to start to look at. So you start to look at when the trade war starts to weigh on China's GDP, manufacturing production. That's when the market's going to really step up and take notice. So be aware that the rhetoric is stepping up, and also be aware that with the US dollar, there's some strange thing that's been happening in the market recently, is that there's been a lot of risk-off sentiment. We'll come on to that, why that is recently. But the risk-off sentiment has been typically associated with yen and Swiss franc buying and US dollar buying. That's what happens in a risk-off environment. But recently that hasn't. We've had Japanese yen buying, yes. We've had Swiss franc buying, yes. But the dollar hasn't been being bid. Now, part of the reason for the dollar not being bid is it's thought that with the Fed taking a more kind of optimistic stance about the future, growth from the US is very strong. They've said we're not only going to have the rate hikes we've expected, we're also looking to maybe keep on hiking rates, a very bullish stance. Then investors have suddenly thought, well, hang on, the US could get in a bit of trouble because the US has a current account a deficit, unlike Japan, unlike the Swiss. They have a current, they run in a current account surplus. The US doesn't, okay? So if there's higher borrowing costs, which comes from the higher interest rates, and these Chinese trade war steps up, if there's trouble in Europe with Italy, you know, the market starts to get concerned. Well, maybe the US dollar isn't such a strong and safe currency as previously. So those kind of influences are going to start to weigh on the US. And on top of that, we've seen a fall in the equity markets. Now, this has been very marked. You wouldn't have missed this. Trouble in the equity market. So here's the S&P 500. This is the weekly chart. We saw a big fall down here, and I think you go to the daily chart and you look at the 200 SMA. You can see that price is fallen below the 200 SMA and may close below the 200 SMA again, which is, you know, a multi-year trend line that it will be broken. It is, you know, it's first time since 2016 that that's happened. So very, very significant moves happening in the equity markets, and this is further weighing on the US dollar. Here's the FTSE 100 closing below its 200 EMA, and the psychological 7000 handle. You see that close, that was last week, okay? And we are currently, let's just have a little look. We're currently at 7007.58, so we're just hovering around that 200 moving average, and it'll be quite interesting to see where does that indices close. A close below that is going to indicate more downside, and that's going to indicate more pain for the whole global economy with these indices being weighed. You know, and that's the first time since August 16 that it's been below the 200 moving average. We've got the Nikkei 20, the Nikkei, and you can see the Nikkei fell off heavily again. This is the weekly chart. So, you know, and again, the Nikkei was down about 1.something%. Hang on, let me have a look. It was down 1.87%. The Nikkei was down. So you can see that, you know, that's the trouble that's going in the equity markets, and the market is concerned. That's why we're seeing risk off sentiment at the moment. Yen being bought, Swiss franc being bought. There's so much going on in the markets. In fact, you know, it is more than I can actually cover in this hour. But they're some of the main factors. Let's start looking at the week ahead so that we keep within our time and don't run out. But I hope that's giving us some education what's going on. So looking ahead today, we've got the retail sales coming up. Now this is going to be quite important, because if the retail sales are really good, and you know they're 0.3%, 0.4% expected, but if they start coming in 0.5, 0.6, that kind of level, a really good indication then that will probably give some relief to the equity markets, because people think, oh, okay, the US economy is doing good, it's okay. But if that's a soft number, if that's a fall, then we're going to see more US dollar weakness and more equity falls as well. You're going to see the S&P 500 is not going to be able to break above the 200 moving average on the daily chart. Almost certainly is going to, and the equity problems carry on for the reasons I've outlined. You know, the concern of the US dollar, the higher interest rates that are coming. But actually, if the economy isn't as good as it was thought, then what we might see is the Federal Reserve tracking back on some of their expectations of hiking interest rates. So, you know, the retail sales in themselves are going to be going to set the sentiment for the next, 24, 48 hours. So have a look at those retail sales figures and how they come out. Interestingly, we've got the CPI data coming out of New Zealand. Now, that's going to be viewed, interestingly, the New Zealand, the Reserve Bank of New Zealand have been quite bearish recently. They said they're going to keep their rates lower for longer. They cited a lack of business confidence. So this CPI inflation figure is going to be kind of a litmus test to say, well, was the Reserve Bank of New Zealand right to be so cautious, or maybe they were too cautious? So at the moment, they're expecting 0.7%. If that's a beat, 0.9%, 1%, then the market will start to think, well, hang on, Governor Orr was just too cautious about the New Zealand the economy, and actually it's doing better than he thought. And although business confidence was down, actually the inflation is indicating that things are going okay. So that is going to be a measure against the Reserve Bank of New Zealand's stated and explicit a more bearish policy. So have a look at the CPI data and have a look at some analysis as soon as it's released, and then you've got the backstory to understand it. We've got the RBA's meeting minutes, so just again check that out. But there's nothing particularly changing from the Reserve Bank of Australia. I think they're not going to do anything with rate hikes for I think till 2019, and there's nothing particularly of a surprise. But again, what you need to look at with Australia is what's happening on with China, because remember, China and Australia have a very close connection. About 30% of Australia's GDP is derived from exports to China. So a slowdown in China's growth is is going to affect the Australian dollar. That's the relationship between the two. So whenever you see good data out for China, that's also good for Australian dollar. Whenever you see bad data out for China, that's bad for the Australian dollar. You got some average earnings coming out for Britain. Nothing particularly to look at. The big issue with the UK, of course, is Brexit. That's going to be the number one driver of sentiment. Going forward on Wednesday, did we have some Chinese data out? Yeah, we got some Chinese data out. I think there's a GDP out this week. It's not that information, but you want to just keep an eye on what's happening out of China. Got the Brexit summit is again big headline risk there. So the way to be looking at that is, if you're at your charts, you want to look for headlines that are coming over, and if there's a big headline, try to join within the first 5 minutes of that headline being released. So the kind of headline I'm talking about, again, this is not advice, it's just showing you how to do how to trade a headline. It'll be something like, Britain agree new trade deal with EU. If you're there and that happens, then that's a pound buy within the first 5 minutes, and you're in at the right time. CPI data out of the UK, again, it's Brexit that's really the big issue. The FOMC minutes, okay, that's interesting because the Federal Reserve is on a more bullish pathway than was previously expected. Powell came out after the last Federal Reserve meeting and was much more optimistic about the state of the US economy, and set the US dollar on being bid after the last Federal Reserve meeting. So have a look at the minutes. The market's going to be reading the minutes to see what were there any caveats to that bullishness? Was there any concern about the equity markets? For example, were they saying an equity markets are strong, and now 2 weeks later the equity markets are falling? Then that might change how the market is viewing the current situation. So they're always worth reading. Now, if you don't understand how to interpret all this information yourself, you want to look at a good currency analyst, and they will, read a few analyst pieces, and that will help you interpret the data. Again, we got some unemployment rate and participation rate out for Australia, just worth having your eyes on. I'm not expecting necessarily anything significant from that. Friday, then we've got I've got GDP out for China. Now, it's just worth looking at this because of 6.6% expected, 6.7% last time, 1.6% for this quarter versus 1.8%. Looking for a slowdown here. If there is a slowdown in the GDP, then the market's going to start to think, well, this US-China trade war is starting to weigh on China's economy, and that in turn is going to be a bearish global sentiment, really. So have a check out of that GDP data that comes out on Friday. Then looking to Canada, the Bank of Canada is almost certainly expected to hike rates when they meet next week. I think it's 24th of October. So this data, the CPI and the retail sales, isn't really going to change that. It's about 90% expectation that Canada will raise interest rates. The oil prices have dropped off a little bit, but even a miss on these two is not going to be the end of the world. And if you get a beat, it's not going to particularly affect the Canadian dollar. Although what the market's going to look at, they're going to look for this to think, well, this is kind of one of the final confirmations about whether the Bank of Canada is going to raise their interest rates. So if there is, a big miss on these, big miss on CPI, big miss on retail sales, when I say big miss, I mean, 0.4, if it's, for year on year September, if it comes at 1.4%, and then this comes out minus 0.2%, and retail sales comes out flat at 0%, that's what I sort of what I consider to be a bigger miss. And then the market's going to think, oh, actually, is the Bank of Canada still going to raise interest rates now? And then that's going to weigh on the Canadian dollar. Flat or just a minor miss or small miss isn't going to really affect the path for the Bank of Canada coming ahead. So there's been so much to look at this week. It's been hard to fit it all in, but we've managed to cover it. Okay, guys, if you've got any questions, please do ask away. There's a lot going on, and one other factor just to let you know is the bond yields for US 10-year Treasury bond yields. The market's been eyeing that because when the reason the yield's been there's one last thing that I must show you is gold. Okay, you must see this gold chart. Now, this is what's going on with gold. It's more important than the yields. And recently, the gold chart has, you can see, look, since June, since May of this year, price has kept under the 100 moving average. Then recently, we've had this huge breakout in gold, and we can see technically, look, it broke this 1.2, whatever it is, 1.212 roughly, 1.215 roughly, let's say. It broke that level, clear breakthrough. Now, why? Well, the reason is because with bonds becoming less valuable, that's what it is with the US. This is what reminded me, because with the 10-year yields, with the yield rising, it means the value of the bond goes down. So bonds are losing value. Remember, the equity markets, I've just shown you all those across the world, all those big indices falling. So people are looking, where can I make money? Because if the bonds if the bonds are less valuable, and if the equity markets are plummeting, where can I go to find, and the US dollar isn't a safe haven as it used to be. Where's a safe haven? Now, gold has suddenly given its appeal as a safe haven. Now, it's kind of the last resort safe haven, gold, really, because gold in itself, you don't get any return for holding gold. Okay, you've got gold. Okay, you've got gold, and you've got the price of the gold. It's not like you get a swap in the currency, or you get a dividend, you don't get anything, or you get a coupon like you do with bonds. You don't get anything for holding gold. So in a sense, it's kind of the safe haven, kind of last resort. And this is indicating, this is telling you the market is pretty scared, because the market has suddenly invested quite a lot into gold. So I'm expecting gold, as long as this sentiment carries on, I'm expecting gold to be bid. Now on Friday, I saw this and I entered against the 100 moving average just there. When I saw this test here and I realized what was going on, I was able to enter the market there. So a good place, another good place to enter is the 100 moving average, 200 moving average on the 15-minute chart, or a 50 moving average or the 100 moving average on the 1 hour chart. Very good places to rejoin gold. In the workshops, I'll be going into that in more detail. You will find details on your email, but I will show you. This is how you trade. You find the fundamental story, and then when you have the fundamental story, you apply the technicals to the fundamental story. It is not any more complicated than that. Understand the story, then find a sensible place to enter, define, limit your risk, and book your profit or take your loss, and you just becomes a repeat process like that. Okay, guys, I'm sorry about that sudden change, but I wanted to show you. Ashutosh, your question there. If you yes, you can trade. You need to refer to HYCM, and if you go to their customer support, they will help you with all your relevant questions about trading from your particular location. So Ashutosh, do contact them. Okay, well, thank you very much for your time. And I'll close by saying we will once again have our next webinar next week, which will be on the same day next week at the same time, 12:30 GMT. Thank you very much, which is the same time as this webinar. Thank you very much for attending, and I look forward to hopefully welcoming you again next week. Thanks now. Bye.